Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Greetings and welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. For generations, the house rules of entrepreneurship have repeated the same tired mantra. If you want to scale a business, you have to borrow money. We are told that a massive line of credit, a corporate loan, or an aggressive venture capital backer is mandatory for success. But as an investor looking at a balance sheet, you must be very careful with how you manage your debt. While debt is leverage, it can also choke your cash flow before you even acquire your very first customer. Today, we discuss the mechanical illusion of the funded startup, the mechanics of a lean balance sheet, and why launching debt-free may give you an unfair competitive advantage in the modern economy. One of the biggest shifts in an entrepreneur's mind is understanding what happens when they fully get the fundamental accounting equation. The architecture of that equation is very simple. It's assets equal liabilities plus equity. Otherwise stated, every asset in your business came from two places. Either you borrowed money to acquire the asset, or you used your own personal capital, i.e. equity, to acquire the asset. When you start a business with a commercial loan, you increase your assets on day one because you have cash in the bank. But you also simultaneously create an equal unforgiving liability. Let's look at the math of a traditional debt-funded launch versus a debt-free launch. Imagine you borrow $50,000 to launch a new venture, saddling your business with a fixed monthly loan payment. The next month, even if your revenue is exactly zero, that liability demands to be paid principal and interest. In accounting, this drastically inflates your fixed overhead break-even point. You are forced to make sales just to stay at zero. Conversely, a debt-free launch relies entirely on the equity of the owner or the bootstrap capital, keeping your liabilities at zero. If you take 3 or 6 or 9 months to find your footing and get your first customer, what difference does it make? Because you don't have a debt payment to make. While a debt-free business is simple because you can have a competitive advantage over your competitors based on cash flow, it doesn't work for everybody. So you have to be mindful and careful how you consider this.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
In the world of financial reporting, your cash flow statement will reveal the structural vulnerability of debt. A standard corporate cash flow statement is divided into 3 distinct gates: operating activities, investing activities, and financing activities. In a debt-heavy startup, your financing activity shows a giant cash inflow on day one, but a relentless monthly cash outflow every single month. That financing can drain the capital away from your operating side. When you launch debt-free, 100% of the cash generated from your operations stays right there in your operations. You instantly can reinvest for marketing, hiring more talent, or pivoting to meet a change in the business demand. As an entrepreneur, there are many ways to evaluate your success. When you become a KingLife member, we help you determine what's the best metric for you and your future. I'm Nathan Weaver. We'll see you next time.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.